This week we're going to start off by taking a look at a couple exercises from Chapter 22. The first exercise we're going to look at is going to be allocating wage among the varied departments of a company. Here we have one employee and she's going to work for both the jewelry department as well as the hosiery department. Over a 2-week span, she earned a wage of $30,000, but in determining what the cost should be for each department, she split her time between those. We want to take a look at the number of hours she was actually working for each department to divvy that wage up between those departments to allocate the cost. We're going to do that by first adding up her productive hours. So with the jewelry department, she had 51 hours of selling and 6 hours of stocking, so a total of 57 productive hours. For hosiery, she had 12 hours of selling, 7 hours of stocking, for a total of 19 productive hours. And then she also had 4 hours of idle time. So that idle time is not going to get charged to either the jewelry or to the hosiery. So we're going to have a total of 76 productive hours here. And we use that to find the ratio that she worked for each of those departments. So for example, in jewelry, she worked 57 of the 76 hours, or 75%. And for hosiery, 19 of the 76 hours, for a total of 25%. Once we know the percentage of her time that was spent with each department for those productive hours, we're going to multiply that percentage times the wage. So here, 75% times 30,000 to get 22,500 that will be allocated to jewelry, and then 25% times 30,000 to get 7,500 allocated to the hosiery department. You'll note that even though adding the productive hours up, you're going to get a number less than 80. You're going to get 76 in this case. Once we add up the wage allocated, we're still allocating the full 30,000 between the two departments. The next exercise we're going to look at is going to be a decision whether or not to eliminate one of the departments that we have. For example, what we're looking at here is going to be the ski department. And we've got a departmental income statement that we're going to build out based on the information that's provided above, including sales and cost of goods sold. So we'll have sales of $605,000, cost of goods sold of $425,000, and that's going to yield a gross profit of $180,000. Once we include the operating costs, we're going to have salaries of $112,000, utilities of $14,000, depreciation of $42,000, office expenses of $20,000. So we're going to include all direct or indirect expenses on our departmental income statement, which would yield $188,000 for the operating expenses. So that's going to imply a loss that the department's running of $8,000. In making this decision, we don't simply just look at the departmental income statement. However, we want to know how much is being contributed to overhead. So one example to kind of think about this is going to be that if we have a warehouse and it's got a portion of it that's utilized by one department and another portion is utilized by another, we're still going to pay rent on the entire warehouse. So that expense is not going to go away. Here we've got similar portions of these expenses that are similarly situated. So for example, for our salary, we have $112,000 that's associated with the ski department, but $15,000 of that salary may be a portion of a manager's time that oversees multiple departments, or maybe a manager that we're not going to be able to eliminate is still going to be part of that overhead expense, or that it's going to be part of that indirect expense rather, that we're not going to be able to eliminate if we eliminate a department. So we're still going to pay the $15,000 either way. Utilities, we're going to have $3,000 of it that's going to be indirect. So even if we shut down the ski department, we're not going to be able to reduce the $3,000. So what we want to do is look at, well, what expenses would be reduced. So we're going to start off the same way with the $605,000 for sales, $425,000 for cost of goods sold, for the gross profit of $180,000. Here, for the contribution to overhead statement, we're just going to look at direct expenses. So for salaries, the $97,000 that could be eliminated if we eliminated the department, the $11,000 of utilities that could be eliminated, $32,000 depreciation, and then for office expenses, all of it's indirect. So we're going to pay for those office expenses either way. So this might be something along the lines of payroll or various expenses or miscellaneous expenses that are picked up by the office, and then regardless of whether we have this department or not, we're still going to have that as an expenditure. So it's not going to be eliminated even if the ski department is. So once we look at those expenses, we'll see that we have 140,000 expenses. So the ski department, in terms of contributing to those indirect expenses and to that overhead, is actually contributing 40,000 to help pay for those expenses. So here, even though on the departmental income statement it's an $8,000 loss, we would not want to eliminate this department because it is producing contribution towards that overhead. So if we were to eliminate it, for example, then the income would decrease initially by 40,000. And then the last expense we'll look at is going to be one of these managerial decisions. And specifically, the one we're looking at is whether or not to make the product ourselves or not. So we've got some information on our company here manufacturing a crucial part, and we've got a cost of $4.45 for that. We've got 65,000 units per year is what we typically would have for production. But what we're going to want to do is look at how much of that is variable cost and how much of that is fixed cost. Here we have $1.95 is going to be the variable cost, fixed cost is going to be 65,000. And we're going to have allocated fixed costs are going to be 58,000 per year. So what we're considering as an alternative is going to be, instead of making this part, would be purchasing the part, and the purchase price would be quoted at $3.50. So we want to set up this as apples to apples comparison to where we can make a decision. So we're going to want to chart out the relevant information here for that decision. So the first thing we're going to do is look at the variable cost for manufacturing it. So we're going to only look at the $1.95 right now, rather than the $4.45. And we're going to multiply the $1.95 times the 65,000 units, and we'd have 126,750 is what it would cost in variable cost to produce those units in-house. We're also going to look at the incremental fixed cost. So we have allocated fixed costs of 58,500, and we have an incremental fixed cost associated with these 65,000 units of $65,000. So the total incremental cost that we have to make this is going to be 191,750 to make those 65,000 units in-house. And then the calculation for purchasing 65,000 units is going to be that $3.50 times the 65,000 units. So here, 227,500. And then the total incremental cost to buy is going to be 227,500. So even though we're quoted a price at $3.50 that's less than the $4.45 that the all-in price per unit that we have, it's important to break that out to see what variable costs could actually be reduced by not making the product in-house, and then what fixed costs would also be reduced as well. So we've got a portion of these fixed costs that are included in that $4.45 number that would not be eliminated. And that may be because the machine is already needs to be kept in operation for other products that we might be running through it, and we can't completely shut it down. Or it may be part of the warehouse or utility costs that we have set up to where we have a fixed cost that's going to be allocated for these parts and for other parts that we're running through the department. So 58,500 previously was being shared among this part as well as other parts, and now it's just going to be shared among the other parts. So it's going to be something that we're going to have to pay one way or the other. So we're comparing the relevant costs, only looking at those that we could eliminate, similar to the cost that we had eliminated in the previous exercise with the ski department. So our conclusion and decision here would be that we should make the 65,000 in-house rather than purchasing them. And the reason is that the incremental cost is 35,750 less than buying it. And we'll note again that the allocated cost of 58,500 is not going to be a relevant cost for this apples to apples comparison.